Welcome to another Ronel Talks Money show. Today we are going to talk about financing. And I know we always say that you need to try and be debt-free, but it's not always possible. And therefore it is important that you understand how you can also use financing to your advantage and how you can actually also build wealth by using financing. So yes, debt is not all bad, but it is important that you know how to manage it to your advantage and how to manage it well. And today, to help us understand financing options and what you need to consider a bit better, we have Christiaan Jansen with us. And Christiaan is from at 360 Finance. So Christiaan, welcome and thank you so much for joining us today.
Thanks so much, Ronel. It's great to be here. I look forward to our conversation.
I'm sure we're going to learn a lot, and I think there's a lot of people who would be keen to know how they can actually get finance, because I think that is also something that quite often people avoid doing certain things because there is a perception that they won't be able to get financing or funding. And you can maybe just kick off by telling us a little bit more about at 360 Finance. What do you do? What do you offer?
Yeah, so at 360 Finance is a boutique financing origination company. So basically what that means is we look at any types of financing, excluding personal loans, where we can assist clients with obtaining the requisite finance. So the core backbone of the business is residential bond origination, where we go to all of the banks on your behalf to help you with home loans. But we also offer commercial financing, agricultural financing, bridging finance, medium-term business loans. So basically any type of financing that can help your business. And that's exactly where the company name comes from, to help you with a 360-degree view of your financing needs.
Okay, excellent. And then, Christiaan, I think if we start off with buying a residential property, I think the one financing option that we are all familiar with and that we usually would go to first would be your bond or your home loan from a commercial bank. Now, would you say that is still the best route to go, or what's your view on that?
Yeah, hands down, because it will always be your cheapest form of financing. I mean, a residential bond is the backbone of many of the bank's long-term assets, and lending there is tied to your prime rate, and it's typically quite cheap. I mean, if you look at a bond, if you get it at the current prime rate of 7%, you're paying 7%, where if you go and take out a personal loan, you're likely going to pay 18 to 22, maybe even, I think it's capped at 34% if I recall correctly. So way more expensive capital, and it's a long-term financing solution. There's one other option as well. A guy by the name of Meyer de Waal has rent to buy, where it's on an installment sale agreement basis. But there also, it's a prime loaded loan. It's typically prime +2. So a residential bond with a commercial bank is definitely the way to go.
That is good to have confirmation of that. But then I think for a lot of people would think, but they do have a primary residence and then they consider buying some investment property. But how would the financing be different from financing your residential home to financing an investment property?
So the principles are the same. The whole matrix in terms of qualifying for the bond is identical. The only main difference there, and that's part of the consideration, is with your own financial planning. Are you intent on building a massive portfolio for long-term retention, then and even asset protection, then to have that inherited onto your descendants? You'd likely want to look at a structure where you either purchase in a trust or in a company. But the other alternative of it, if you do everything in your personal name, just remember there's going to be a lot of estate duties. and capital gains tax implications. So that's one of the considerations when you look at an investment property, where with your primary residence, you've got your capital gains tax exemptions. So it's typically a good idea to have your primary residence in your personal name. Although if it's going to inhibit you from additional bonds on account of your bond qualification, it might also be worthwhile considering moving that into an entity structure, but that's on a case-by-case basis.
I think that is very good advice for people to realize and to understand. But then there's also, I think, the costs, because quite often people want to buy a property and they think, well, once we've got the bond, then there's no other costs involved. And then quite often there's quite a big surprise for people when they realize how much additional costs are involved. So maybe you can also just tell us a little bit in terms of what are the costs that your bond will most likely not cover.
Yeah, so for a first-time home buyer, you could potentially get costs included where they talk about 105% bond. So a little bit of a subsidy from the bank's side to help you to acquire the property. There's a lot of red tapes and requirements for that though. But with a normal, let's say you buy a house of R1 million and you get 100% bond, you're going to have to pay the bond attorney that the banks appoint to register the bond. And you're also going to have to pay the transferring attorney who's transferring that property into your name. If you go over R1 million, there will be transfer duties as well, and that's to SARS. So you can ask the bond attorney as well as the transferring attorney for some discount. SARS will never give you discounts. So those are the costs that you'll have to prepare yourself for. And then also when you sell it, obviously you'll have bond cancellation costs that you just need to factor into your calculations. That's typically about R4,500.
No, that is definitely good to know about all these costs so that you can prepare a proper budget and so that you can also look at affordability. Are you really in a position to afford all of this? But then I think, Christiaan, the very controversial topic where a lot of people have very different views, and I would like to get your view on this, is where some people feel that it's best to buy a property cash or pay a big deposit on it, and other people would feel that it's better to have finance in place for a property. So just give us your view on this.
It also depends on your own goals and your needs and means. A primary residence will never be an asset, whether you pay a bond on it or not, but it will be one of your biggest cash flow liabilities. So I'd say try and pay off your primary residence as quickly as possible. But with investment properties, if you buy it cash, you are basically missing out on one of the most important elements to return on investment, and that's leverage. I mean, let's take it at a normal flat 500,000 Rand. If you've got 500,000 Rand cash, yes, you'll get your rental. You'll probably net a return of about 12% year one already, excluding capital gains. But if you were to put down 100,000 Rand deposit, you could technically buy 5 of those. I'm not accounting for the bond and transfer costs now. And although they will be close to break even, your income will be 5-fold as those properties pay themselves off. So if you require the cash flow out of the property, then it might be beneficial to put down a larger deposit. But similarly, so if you're at the beginning of your property journey, it might be best to finance it to the hilt, try and get as much of the bank's money into the picture so that you can use your capital as working capital to either improve on it to increase your rental or to buy more property.
I agree with that. And I think it's also about, going back to the numbers and never kind of make these decisions based on what somebody else say or whatever. Go and do the numbers and see for yourself what makes financially the best sense. Because like you said, you immediately think, I don't want finance, but if you go and do it over the longer period and you understand the benefit of leveraging, then you would see and you do the calculations that you are going to receive some benefits. But then also, if I think about if you have to go and apply now for a bond or financing, what are the typical requirements that the bank would ask or would need from you?
So first and foremost, it comes down to bond qualification. So the banks have to make sure that your affordability is in order. Part of that affordability is also that they will conduct a credit check. So they'll have a look at your existing credit behavior to determine whether you are a responsible credit user or not. And that score will also have an impact on your interest rate. Once all of that has been checked, so sufficient bond qualification, sufficient disposable cash flow, and good credit score, they will look at the property. If the property is deemed unacceptable risk, they'll decline, even though they approved you as applicant. But if the property is in a good nick, then they will approve the whole bond. And the condition of the property is the further element to what type of interest rate you can expect from the banks.
You have touched a bit on this, but if you want to buy an investment property or want to expand your property portfolio, in terms of buying it in your personal name as opposed to buying it in a company, just explain the pros and the cons to us as well.
Also, short term, one of your biggest cons if you buy the properties in your personal name is that your bond affordability will dry up. The National Credit Act limits you to 30% of your gross income as maximum bond installment. So as you buy more properties and they are evident on your credit bureau report, the banks will discount those installment obligations. And it will run out faster than what the rental income can subsidize because it's only 30% of that rental income that would be allowed for an installment, also subject to the bank's own inclusion rate of how much of the rent they'll consider. So when you look at an entity, if it's a trust with two trustees, one of whom is an independent trustee that's a company, or three trustees and more, one of whom an independent trustee, or a company with an asset value in excess of R1 million, it becomes what they call a National Credit Act exempt entity. That means that that entity will gradually start gathering its own steam and momentum, and all of the suretyships and the bond exposure that you sign in that entity will only be visible to the bank that offered the financing. So it gives you the opportunity to greatly fast track and grow your portfolio. I mean, on a simple calculation, if you qualify for R1 million and you finance properties to the value of R1 million at each of the four major banks in entities, it basically means you can finance up to 4 million. Also, just considering own cash flow planning and everything. So don't just go and get as many bonds and not have the necessary safeguards for vacancy or maintenance or just plain cash flow to cover all of it. So it makes a massive difference. And one of the big things with it is your estate planning. If you've got a properly set up structure, your estate will not have any of those assets as part of it. And that ultimately makes a massive benefit available to your descendants because, I mean, one of the most expensive things we can do is to pass away.
True that. And that is unfortunately going to happen sometime. Yeah. Christiaan, I think that is actually excellent advice, and that's really good for people who are considering going the route of buying some investment property to really know these things and understand it and to make sure they make the best decisions when it comes to these kind of options. But then I also want to ask you about entrepreneurs. I work with a lot of entrepreneurs, and I think the general perception is that entrepreneurs struggle to get financing. And so I want to ask you, you're working with this every day. Is it true? And what can entrepreneurs do to enable them to buy property?
So step one, do away with the whole thought of I've got financial statements for the bank and financial statements for SARS. It's not that the banks are agents for SARS, but they will confirm your tax compliance. So as an entrepreneur, if you're a sole proprietor, so you're trading in your own name, the banks will look at all account turnovers. They'll look at your tax return. Important note there as well is to have your accountant show your gross revenue on that tax return, because that ultimately gets divided by 12 to calculate an average monthly income, and then just proper diligent bookkeeping. So you need to show 2 years financial statements, whether you're a sole proprietor or operate via a company. And those statements need to confirm the sustainability of your earnings. So from a company point of view, a lot of us draw minimum salary to pay as little tax as possible. Nothing wrong with that. Once again, the banks won't penalize you for it. But if you're applying in personal capacity, the banks are going to rely on what is hitting your account. I had a good example now with one of my clients that had a declared income letter of 50,000 Rand per month, but the only amount that was hitting his bank account was between 12 and 14,000 per month. So immediately the banks asked questions, because that's not sufficient cash flow, and he was busy buying a property of about 1.2 million. So on 50 grand, he definitely qualifies, but the position and the presentation of it is not supportive of that. So in his case, what we had to do is we just had to wait 1 month where he paid himself the full salary. So yes, there's a tax implication, but ultimately with that account hitting, or that amount hitting your account, you are proving to the banks you've got that income. I mean, personally with me now, I draw minimal salary from my business, operate on my loan account, as we all do. But with me now on the brink of applying for more financing, I've now over the past 3 months started paying myself a normal salary. I've got my pay slip, pay as you earn, and everything gets deducted as it should. And based on that, I will be successful in my bond application. So it's just a matter of how you prepare yourself and make sure that everything corroborates. A very stupid mistake that gets made, and I don't quite know, it's not that I'll knock on any type of profession, because all accountants and bookkeepers have their own interpretations. Everything will work out the way that it should, but your presentation and the financial statements, if you don't make mention of directors' remuneration or salary components in those statements, the banks are going to completely disregard your earnings. So it's a couple of little things that one may need to tweak, but I am available on a consultation basis to also assist with the preparation for that.
I think that is so important, because quite often people are just not aware of these things. And I think it's also, again, emphasizing why we are always saying keep your business and your personal finances separate. Do that, paying yourself a salary, do the pay slip, do all of those things, because you might think it's a lot of admin and your business is not big enough or whatever, but at some point these kind of compliance things would kind of count against you. So rather do it on the correct way, and then when you get to these situations, it's much easier for you to prove, because you do have all the applicable documentation and compliance in place. But then I also want to ask you, because now sometimes it just happens that people, they try to apply for bond financing and they simply just can't get it for whatever the reason might be. But they are still very eager to invest in property. So what alternative solutions are available for people to look at?
Well, it comes down to being creative. You've got many a way that you can put a deal together. And I'm a big proponent of saying, you don't get what you deserve, you get what you negotiate. And I've got a lot of property investors with whom I deal who do not qualify for financing. One of the guys, as an example, is blacklisted, and it's a very deep hole that's going to take him some time to get out of. But he just started forming partnerships. Get somebody else who has bond qualification, who has affordability, who's time poor but money rich, and have that person stand in as the director to the company, have them apply for the finance, qualify for it, and you put a deal together. Other side of it as well, purchasing with what they call seller financing. In other words, I, for example, purchase your property from you, but I don't apply for a bond, I pay you. So that's an installment sale agreement. I mean, that legislation has been available in South Africa since 1981. A lot of farms are still being bought and sold that way. And you dictate your terms in terms of how you just put that together. So there's always a solution. And the other alternative, of course, in many an instance, if the banks decline you where you were convinced that you would be approved, it might mean there's one or two little things that you need to tweak to just make sure that you are bond ready when you get to that point.
People to understand that it's important that you don't get into a situation where you are so over indebted, but it should also, so you should still be money savvy with all of these decisions, but there's always hope and there's always a solution. So you shouldn't kind of use this as an excuse not to start investing in property or start creating wealth for yourself because you believe you cannot get a bond or financing from a bank. But what I like what you said in terms of one of your services where you mentioned that you are also looking into agriculture. And I think especially now during this lockdown period, there was quite a big trend that we are seeing towards people venturing into some kind of farming projects or ventures or whatever. And I think there is still a lot of people that would like to venture into something like that. But you can also maybe just tell us a little bit about that. Is it difficult to obtain financing, and what should you typically know about or consider if you want to venture into something like that?
So it's a very specialized type of financing. And one of the key metrics with that, agricultural financing is based on the commercial operations. So you need to present a financing proposal that shows, point one, the jockey behind it. They look at prior experience. Point two, the operations. Point three, the expansion thereof. And then point four, your repayment terms. Because agricultural finance can also lead to having biannual payments or quarterly payments, dependent on what produce you're involved in. So there's a couple of moving parts in there. And some of the simple things we've picked up, like a certain type of cattle that at most will only yield a calf every 22 months. And the initial presentation shows that they'll have a calf every single year. Little things like that will immediately have the application rejected. Water on the property is very important if you're going to be sowing and harvesting. So a couple of things that will be based on a case-by-case basis, but ultimately it just comes down to that operation needs to be able to cover the installment obligation that you're busy applying for. So it's a little bit trickier than your typical commercial applications. One of the key things also is the banks will send out an agricultural economist to come and look at the property. They will look at the operations. They will see what has happened, what you're intent on doing, and how to approach it. I mean, little things like one of the clients we helped a couple of years ago who was expanding on his cattle farming. There's progressive thinking from a lot of these guys as well, where with this specific instance, they said with I can't recall the number of head of cattle that he was looking at expanding to, but they deemed the grazing insufficient. And part of the whole financing then included that he plants produce to feed the cattle and also a tractor to manage all of that. So it really comes down to a case-by-case basis. But the most important thing is if you're going to venture into it as a complete rookie, you're going to have to put a lot of emphasis on who is going to be managing it and who's going to be running it from an operational point of view, because the banks will want to see some form of experience and capability. And it's the same with the development finance. If you now get up in the morning, decide, I'm going to become a property developer, you go to the banks, they're going to say, oh, sorry, but there's no experience. We don't know that you can deliver on this. So partnerships are also important there.
Good advice, because I think a lot of people just, jump on the bandwagon and now I'm going to become a big farmer without really understanding all of this. And I think especially if you don't come from a farming background, you are not extremely knowledgeable, it's so important to talk to the right people and make sure that you do the research and that you get some proper advice, because obviously this can also go terribly wrong if you go along some kind of path and it's not been thought through well. But then I also want to ask you about business financing. Like I said, I work with a lot of startup businesses, and I see a lot of the bigger organizations working specifically with financing for businesses, that quite often the requirements there would be, that the business is already very stable, that they have 3 years of financial statements, that they're making good money, and also that their need for financing is for quite a big amount. And it often feels that the smaller businesses who are startups, or the businesses who do not necessarily have the capacity to make millions, and they also don't need millions in terms of financing. They maybe need a couple of 100,000 Rand or 200,000 Rand, something small, but they don't yet have that stability, that track record, big profits to show. What's the solutions for those kind of businesses?
So your normal commercial banks will always look at stability and repayment ability. Any financier will want to make sure that you are able to repay the loan that you're applying for. So that's step one. The harsh reality of it is we're not getting the requisite support for small businesses that has been promised from many chains up for how long, but hopefully things will start improving with that. I know there are a couple of advocates for it making a lot of noise, but you've got your venture capital financiers. So if the idea is very good, and you have proof of concept, they typically come in on an equity basis where they'll start investing into that business to help it grow. But you do give up quite a big part of your business for that. So that's one of the considerations to look at there. And then the other side of it would also be some of your hard money lenders. So there are a couple of organizations, like just immediately what's popping to mind is Lula Lend, who will, with 1 year's operations, already offer financing. But you're looking at 2.5% to 3% interest per month. So it's in your best interest to get that interest to get that repaid as quickly as possible, so that you don't kill your own deal, because annualized that's 36%. So there are solutions here and there. If you're in a movable goods type of setup, you've got a couple of trade financiers that could potentially help. So if you've got an order, everything is put in place there, they may finance the acquisition of the stock and then take profit with you. So there are ways to make it happen, but unfortunately it is a very, very difficult and slippery slope to take on.
I think it always remains those kind of chicken and egg situations where, like on the one hand, we try to encourage people to start their own businesses. We want to create jobs. And on the other hand, there's not always that support coming to just make those businesses sustainable, because I always believe that, it's great to build a big, huge business, but that's not everybody's dream. And it's also not all businesses has that capacity to get there. But if you can at least, be a sustainable business for you as an entrepreneur, and you can maybe just at a later stage appoint one person, that will already make a huge difference. But I think that is unfortunately something that within the bigger South Africa we need to look at, what kind of support can we really give to those people, because there's a lot of people who are trying, but they really are struggling. But then I also want to ask you, you work with these things every day. You see what people do, kind of the money mistakes they make. But once you have now your bond approved, or you have an existing home loan, what are the tips that you will give to people? How can they save on their home loan?
So Einstein calls compounding the eighth wonder of the world, and it can either be in your favor or against you. If you look at a home loan, the interest calculations is done by what they call amortization. So if you look at the duration of the home loan, you'll find that your first installments are almost only covering interest, because the interest calculation, interest is calculated daily but compounded monthly, but that gets done on the outstanding capital balance. So when you get an annual bonus or a payback from SARS, park it in your bond. Convert your home loan into what they call an access bond. So you can apply for that very quickly with your bank. And that means that any prepaid funds are still available as cash. Then outside of that, just focus on feeding more money into that bond. One of the cool examples that I saw recently, and it was quite an interesting lesson for me as well. I never thought of it this way. But one of my clients and his wife, they managed to pay off their 20-year bond in 12 years. The only thing they did was they moved all of their debit orders to go off on the 15th of the month. And then by month 2, what they did was, as their salaries got paid in on the 25th of the month, and part of this also, obviously, their credit card was paid up. So that was one benefit that they had in their advantage. But on the 25th, as their salaries hit their bank accounts, they deposited their full salaries into their bond. On the 13th of the month, they would transfer it back out. All the debit orders will go off. And also at that point, they fully settle the credit card, which doesn't attract any interest, and then rinse and repeat. So they were only drawing out what they needed. And that firstly made them very aware of their budget. And secondly, for 12 years, every single month, 3 weeks of the month's interest calculations was done on just their net salaries less as outstanding capital balance. So it's so simple, but it made a phenomenal difference. If you're not up for all of that admin, you can literally just go as far as adding additional payments to your bond. So if you increase your bond installment by 20% of the required amount, you will cut your term by a third. That's literally as quickly and as well as the bond accelerator strategies can assist you when you look at just playing that compounding game in your own favor. Then personally on my side, with all of my bonds, I calculated my installment at a higher calculated interest rate. So I calculated it at 1.5% above the offered rate. So if I were offered 7% as prime is today, I would recalculate my installment at 8.5%. So on a typical investment flat of 500,000 Rand, it maybe adds about 450 or 480 Rand to the installment. But I use that because it's available in the access facility. I use that as my provision for vacancy as well as maintenance. Because every year you've got that little bit of a cash flow reserve coming up. And over and above that, you are already, from a cash flow point of view, prepared for 6 interest rate hikes at 0.25%. And that makes a massive difference because you are not in danger soon. You've got more than enough time to make a change. And that's one of the biggest gripes that I have at the moment. If you look at how piping hot the property market is right now, so many people are responding to adverts saying, record low interest rates, look at your bond qualification. And somebody that currently qualifies for R1 million, that's on a gross income of about 26,000 Rand, before the interest rates were dropped, they qualified for 774,000. That's a massive gap. And now you get coerced into buying that R1 million property. The rates are going to go back up. Before you know it, you're short on your cash flow because the bond installment has increased too much. I mean, that's going to make quite a significant difference in terms of own cash flow contributions. You're looking at, on a R1 million property, I think it's about R1,900 difference in installment obligation. So that can make or break a whole household. And people do not take that into consideration. So it's very, very important to be diligent with how you treat your bond. And something stupid, and that's a challenge that I'd like to put out for anybody with a bond. When you go to the coffee shops, as we all love to do, order a plain filter coffee instead of a cappuccino. I mean, typically we'll have 2 coffees if we go for a coffee date with a friend, and take the balance and just deposit that into your bond right there on your banking app. Pop it in there, spend some time, do that for 3 months, and have a look at what the available balance or the prepaid amount will show at. Because that's part and parcel of how you game the system into your favor.
Absolutely excellent advice. And if you really think about it, it's stupid things. It's not like highly complicated or something.
It's not rocket science.
Yeah, absolutely not. And it's literally just to go out and do it. I know that the one that you've explained in terms of putting your salary, that is something that I did when I bought my first property. And the difference it made, just to literally put my salary for that period from when it was paid up until when my debit orders go off, I repaid my bond within 6 years. And people would think it is a lot of admin, and you obviously need to manage it well, and you need to do it correctly, because you also don't want your debit orders to go off and then there's no money in your account. So it does take a bit of managing and a bit of time. But I mean, like, after 6 years, you can be debt free, and then the benefit is for the rest of your life. So you've spent that maybe 6 years doing a bit of additional admin, but like you said, it's stupid things. I mean, it's just doing it, and the benefit you get from it is huge. So thanks for sharing. That's definitely something I would encourage everybody to go and try it out, and let us know in the comments what additional tips you have. But then I also want to, because I think a lot of people, especially now during this period where the interest rates drop, a lot of people go out and they go and buy additional properties. But there is the risk of becoming over indebted. And we know in South Africa, debt is a huge problem already. So what are the things that you just need to consider to avoid that debt trap when you really want to expand your investment property portfolio?
So first and foremost, stay away from bad debt. There's good debt and there's bad debt. Good debt is debt that you take out on a property, as an example, where you pay 7%, but it gives you a return of 10%. You're profiting off of that debt. So that's good debt. Bad debt, I mean, a car is probably one of the worst things, and I hate the fact that it's seen as a status symbol, because I don't believe in it. I have no attachment to my car, and I'll buy for as cheap as possible, as long as it just gets the job done to what I wanted to do. But if you buy a brand new BMW for 650,000 or whatever they cost now, the moment you drive out of that parking lot, its value will have dropped by 20%. So what are you buying? And you're paying it off. A lot of people take massive residuals on it. So that also then puts them in another trap. And it's scary to see how many people are stuck where they either have to trade in that car and get a new car, or they need to refinance and settle that outstanding debt. It's horrible. So focus on delayed gratification. Look at what's important for you and stick within your means. A lot of us are entrepreneurs, so we are in control of what our earnings are. If the business starts going well, don't live on that increased earnings. Stick within a specific lifestyle and focus on using those funds to create continuity. That's the most important thing. So for short-term debt or anything like that, I'd say try and get out of it. An easy way to also look at that is if you've got equity in your property, go and refinance it, increase it. So say, for example, you've got 150,000 rands bad debt. If you, and your installment on that is, let's just keep it simple, 5 grand a month. If there's no interest component, that would take you 30 months to pay off. But obviously with the very high interest rates, you're going to be stuck paying that for quite some time. Why not consolidate that into your bond, settle it in cash? The installment on 150,000 rand bond is probably going to be about 1.2 maybe. Stick to paying 5 grand a month back into the bond. So you're not consolidating your debt to pay it off over 20 years. You're actually going to shorten your term because you've got a much lower interest component. And if you're used to paying that 5 grand a month into that bond, carry on doing it. Build up a nice cash kitty. Use that to invest in something to improve your life. Everything comes down to continuity. We're known as the sandwich generation because we're looking after our parents and our kids. How are we going to change that to ensure that our kids don't have to rinse and repeat the same thing? That's the core focus. Look at your end goals.
So much wisdom in what you're saying. And I think it goes back to, financial education. And it is quite often something that people are not really keen on, learning more about finances in general because they believe it's complicated. And if you just really, get this knowledge, you listen to people, you speak to people, you read up and you just see, but there's actually so many things that you can do that can change your personal financial situation completely. And there's actually, there is solutions for you to consider to actually create wealth for yourself in many different ways. And like we've said, that you shouldn't be just you making excuses, but you have never really, tried to see but what possible solutions are there. And it's really, I think, great advice that you are sharing today. But then I want to ask you the last question. Now, for people who have listened to this and they say, oh, excellent, there's some hope for me. I'm going to get into this business idea that I wanted to get into, but I believed I couldn't get finance, or I want to start investing in property. What kind of message do you want to give to people who want to get some finance, but they are a bit unsure or uncertain in terms of how should they approach this?
So first and foremost, if anything gets declined, don't see it as a death sentence. There's always a solution. So most important thing with business ideas, rub shoulders with people in relevant industries. You might just open a door for yourself where another business can look at that as an add-on and actually provide some seed capital. Alternatively, start with something small, build it up, get your proof of concept in place. That will make it a bit easier for somebody to consider financing in there. Because if it's just a pipe dream, you're bound to fall stuck. And don't go completely overboard with the idea as well. I saw an idea for a business a while ago where this guy was adamant that his solution is better than some of the biggest tech giants in the world. But he needs 50,000 rand to be better than them. There's immediately a bit of a red light and a warning sign. So be realistic with your goals and make sure that you rub shoulders with the right people. Find a mentor, find somebody who can guide you and who's willing to spend some time with you to collaborate or to just give you a push or a nudge in the right direction. There's a lot of people advocating for getting coaches, be it a life coach, a health coach, a property coach. It's well worth considering if you're finding that you are the limitation in what you are busy doing. If you're in the right crowd, things will go much, much better and much easier for you. I mean, ultimately, you become the average of the 5 people you spend the most time with. So focus on your tribe.
Christiaan, I really enjoyed this discussion. I think you've shared so much wisdom and knowledge. And like I said, it is a topic that often people avoid, and they think it's just all bad and I must stay away, without really understanding but how you can actually use it to your advantage, and how you can actually make money savvy decisions when it comes to financing. And yes, financing is not all bad. There's obviously good solutions out there as well. But again, you need to do the research, you need to educate yourself, and you need to do the calculations and make sure that the numbers work out, because that's often kind of where people go wrong. So Christiaan, I want to thank you for sharing all your knowledge today with us. It was a really interesting, and I think there's so much things that just come out of it, and that people can go back and apply. So I am going to share Christiaan's details in the description below. So contact him if you want him to help you with your financing solutions and to get approval. As you can hear, he's got a lot of things up his sleeves that he knows about that can definitely help you. So I hope you've enjoyed this discussion. Please leave some comments below, and then remember to subscribe to the channel, and also go to the link in the description field where you can enter our monthly giveaway competition, where you can also win one of my books, Financially Fit and Wealthy. I hope you have enjoyed this, and then I will see you again at the next Ronel Talks Money show.